them for a long time. It changed after 2008, and it became like a metronome every 4 years. That's only happened once in the past, which was the 1950s and 60s, where it became very, very cyclical. But this is perfectly cyclical. And it got me thinking for a while, what the hell? So many of us didn't understand what happened to asset prices after 2008. We kind of knew quantitative easing was happening. We kind of knew stuff, but we didn't figure it out. And what I suddenly realized is that in 2008, we had a debt jubilee. And in fact, it was just forgiveness on interest. You don't pay interest payments. Remember, we did that over COVID, exactly the same mechanism, no interest payments. So no interest payments allowed every government who had basically, they'd all gone over 100% of GDP in debt. So all economic activity, all economic growth was used to paying of debts. To me, gold, complete almost flat line, really, versus debasement, as it should be, right? That's gold's job, it's to be the stable currency. And once we looked at the world through this lens of the debasement of fiat currency, which again is still contentious, becoming less so nowadays, but it was really contentious when we started it, we realized there's actually only two assets that outperform this. One is tech stocks, and the other is crypto. And so that completely changed how I allocated and how I understood tech stocks. I was a macro guy. I hated tech stocks. They're always too expensive. You're always a value guy. And I realized none of that made sense in this market. That's why the value investors have been getting killed, is what had happened was all of this. Now, what is driving this? And I think, Julien, if you can just bring up those demographics and how it's being funded, is liquidity. This is Fed net liquidity. You're probably better to use US total liquidity, because that includes the private sector, because they're now using the banking sector. So what they're doing basically is debasing currency to pay for the debt. It's as old as the hills. It's as old as the story of economies. It's as old as the story of money. And it's happening at a very pernicious rate of 8%. So you kind of notice it, but don't notice it. But what's happening is asset prices keep going up optically because the currency is getting debased. Even if you look at real estate adjusted by the about 9-7%. So you kind of get one asset allocation only, which is crypto, which is bizarre. In a macro world, we now think you need concentrated portfolios as opposed to diverse portfolios. In fact, diversification just destroys returns now because you've got one clear macro factor. So that's really what we're doing. And then we spend a huge amount of time working on the business cycle and the various components of all of this, how it comes together and where we are in timing of that.
And just to reinforce some of what Raoul said, Felix, if you want to pull up this chart on the NASDAQ, I mean, this is including dividends. So this is total return in excess of, our GMI, total liquidity composite.
Anything anymore. And I used to do all of it. I'm like, it's irrelevant if 97.5% of all of it is driven by one factor.
Yeah.
Never been
I remember the shift that you went through. Like, you were trying to just knife catch bonds for so long. And then it's just like, oh shit. Like, yeah, things have changed a lot.
That's right.
Yeah, it's an interesting. So this framework you guys have has kept you on the right side of risk for the last few years now. And something I've been thinking about, I'm curious you guys' thoughts, is
World War II, the US economy was over 100% of debt GDP. Most economies were. What did they do? Financial repression. They shortened the debt. They rolled it every 4 or 5 years. They use yield curve control to financially repress, which is essentially currency debasement. Because they, at the time the dollar was pegged to gold. So it's the only way of doing it that way. And then what they did was wait for population growth. They're the baby boom, the largest in history, and productivity growth from technology. And what happened was GDP grew faster than debt. And over time, debt to GDP fell to a manageable level until the inflation of the 70s, driven by demographics, kicked in. Intelligence, infinite intelligence. And we don't know. And we don't know, what the energy constraints are going to be, or whether there are any, or whether we solve them. We just don't know. So I'd rather be honest with ourselves and say, right, okay, we got 5 years. That's it.
Yeah, I mean, the everything code will basically work until it doesn't. And the reason we know it'll work is, if we come back to the charts for a second, as Raoul had said, GDP's in decline. It's, trend rate of growth is 2%, and keep that 2% in mind, because that's important. The working age population is in decline, productivity is in decline, but debts have exploded. And, something a lot of people talk about is the fact that the private sector has deleveraged since 2008. But what people don't understand is that this has been a forced
balance sheet to the Fed net liquidity. So then everyone's working out the TGA versus the reverse repo.
Yeah.
And then they went, actually, it's total liquidity because we're going to stuff it into the banks. And now the next one is they're going to stuff it into stable coins. All they're doing is fine. I mean, that's Scott Bessen's job, and Janet Yellen's job was the same. They're bond salesmen. They're just, they're masters of the universe bond salesmen, and their job is to find where to absorb this, and that is all part of the M2 growth.
I wanted to ask you guys about that, because there has been that shift. You're right, where it feels like from
is essentially, as Raoul had said, Fed net liquidity adjusted for the repo and the Treasury General account. For Europe, it's something like bank notes in circulation, the deposit facility, the current account, and things like that. So they're not going to be picked out there. But I agree that it will change over time, and these composites will essentially.
I'm sure they'll pick up in M2.
I'm not sure, because, as you say, that's the warehouse. It's the warehouse for government bonds, as we've been talking about. But I'm not sure it'll capture everything.
I was trying to think about that too, because I've been trying to figure out, where does the interest income from bills flow through the money supply, right? Like, does it get picked up in M2, or is it that huge amount of just interest income ends up in money market funds?
Q4 of 2022, when we wrote our article, the turn is near, because people were like, hang on a second, the Fed's, still hiking, they're still doing QT, and yet you guys are talking about liquidity rising. What we were talking about at the time was the turn in our financial conditions index, which then leads Fed net liquidity. Because if you think about central banks, they're really just delayed reaction functions to changes in financial conditions, which are why they're always, so delayed to start hiking. And which is also why, despite, inflation, which we can talk about a little bit later, even when early signs of inflation are coming back, the Fed's still cutting, because they're just behind the curve, but by construction, because they're focused on lagging economic indicators
and rates, and nobody cares. It's like factor on, factor off. That's it. One game.
I think the point is what we've really tried to do is just simplify this all down. And so what Raoul's saying is right. Gold is, the inverse of financial conditions, largely because financial conditions are a function of the dollar. So you have that. Then you've got global M2, which is 3 months behind that. Then 3 months behind that, you've got things like Bitcoin, tech stocks, and the yield curve, right? So actually, it's also a function of the yield curve. Then, you go back another, whatever it is. I mean, financial conditions lead the ISM by 9 months. And then at let's just say the ISM's at T equals 0. What people don't understand is that there's this flow of what we call the business cycle dominoes. So then, at minus 1 month, you're talking about things like hours. So,
and so, yes, as it fell apart from real rates, that really got everybody's head scratching. What the hell is going on? What the hell's going on? Why it completely changed, I'm not sure. What was your explanation for why it changed, Felix?
Well, there's I've heard folks like Luke Roman say where they believe that because in the initial Russia invasion of Ukraine, they weaponized the US FX reserves that Russia had, because they had a bunch of US dollars in their central bank, and they basically said, we're taking those back. You can't use them. So then all these reserve managers at central banks that had a lot of US dollar reserves are like, oh shit, I got to put a risk premium on my US dollars now. So maybe I should diversify more into gold. So the theory is that a bunch of central banks have been buying gold. And I think that's maybe part of it. But
global M2 has exploded, right? So it's like, it just feels eerily similar.
That's bizarrely good. That's a bizarrely good fit.
And I've just taken the same time period for all these charts. And so, a lot of what the Q1 weakness you saw, Felix, I'm sure you will have seen a lot of like the big strategists coming out.
Felix, to go back to the question you raised before is, look, here's something interesting, because 2017 was a big cycle for assets, as we know.
Yeah.
Does this speed of M2 make a difference or not? It's like the question within the plumbing is what actually moves the dial in terms of the ultimate debasement, because this is a super accelerated.
Like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.